You saw red, you assumed everything was falling, but the market was collapsing. But what if that's not what happened? What if money didn't leave? It just moved. This is where most investors misread the volatility because capital rarely disappears, just rotates. And by the end of this video, we'll understand what sector rotation actually means, why IT fell while other pockets held, how professionals reposition quietly, and how to detect rotation before price headlines scream. Don't skip the next section because this is where the illusion breaks. Retail mindset is markets down means everything is bad. Professional mindset is there is a capital flowing. When risk appetite shifts, money exits high valuation sectors first. But it does not necessarily leave the market. It moves to defensives, commodities, PSUs, relative strength names. Rotation is redistribution, not destruction. That's a critical difference. So, why did IT become the source? IT had high valuations, high FI's ownership, and AI disruption narrative. So when the risk appetite cooled, capital trimmed exposure there first. But while IT weakened, other sectors showed resilience. That is rotation, not systemic collapse. Now, here is the part most people miss. If rotation strengthens, market stabilizes. If rotation fails, correlation rises. Correlation rising is dangerous. Rotation prevents correlation spikes. So, how to detect this rotation early? Smart investors usually track the relative strength chart, sector indices versus the Nifty, volume expansion in outperformers, declining volume in weak sectors. When new leaders emerge, price doesn't scream it instantly, it just whispers. And whispers appear in relative strength first. Rotation is subtle until it becomes obvious. By then, easy money is already gone. So, if the sector rotation fails and everything falls together, that is liquidity tightening. But if IT falls and metals rise, if midcaps falls and defensive stabilize, now that is called as repositioning. Repositioning is healthy. Uniform collapse is not. So don't ask, is market red? Ask, who is green? That question changes the perspective. So why is this phase so crucial? In the current environment, IT is fragile, banks are hesitant, macro pressure is building. If defensives and commodities gain traction, rotation is alive. If no sector absorbs liquidity, risk builds. Rotation is pressure release valve. Without it, the volatility escalates. That's the structural market behavior, not emotion. So, what do smart investors do? They don't average blindly in weak sectors. They identify the strength, they monitor capital flow shifts, they adjust the exposure gradually. They don't predict headlines. They read the structure, and structure always shows rotation first. If you have been reacting to red candles, stop. Start tracking green pockets because markets aren't emotional. People are. Capital moves quietly. If you want to understand where money moves before it becomes obvious, subscribe because professionals follow the flow, retail follows fear, and flow always wins.